Hey, how's it going, guys? Welcome back to another episode of mentfx. And in this episode, we are going to take a quick look at why, even when you're trading smart money, some of your setups are either not getting hit as per the way you want them to hit, or not coming to the specific end goal that you always are reaching for when you're taking setups. So oftentimes when we're looking at smart money concepts, I've noticed that a lot of people look to try and pick tops and bottoms, just like retail does, using the concept of order block. So if we just look from what we can see on this chart alone, we had a ton of liquidity resting above these highs. We had that grabbed, that moved down, and potentially you were looking to be a seller here. And lo and behold, it did work out pretty well, but then it went against you. And of course, if you're smart money, you might have been targeting much lower areas in the form of inefficiencies down here, or even lower in the form of some order blocks down here, and so on and so forth, right? So again, risk management is honestly going to be one of the biggest things, even when you're trading smart money. And it's a thing that might keep you from actually making money, and might actually keep you from understanding why your smart money concepts are not setting up properly. Now, the cool thing about understanding smart money is that you now have the power and the ability to actually kind of sit back and wait for that setup. You don't have to be getting into every single order block you see. You don't have to be getting into every liquidity pool you see that gets breached. And you don't have to be getting into every single structure break. The beautiful thing about smart money is that you have multiple places to enter, all of which can give you an RR that might be even better than the original entry. Okay? So something that I see happening a lot is people trying to literally pick the tops and bottoms, which is exactly what retail does, using smart money concepts. Oftentimes, I don't think that you should do this, right? So some of the trades we've caught thus far, I believe yesterday, I just caught a Euro USD trade. Yeah, so I just caught a Euro USD trade right here. And of course, it looks like it's out of kind of the blue. I'm not trading it at a bottom, I'm not trading it at the top, I'm kind of trading it right down the middle, okay? The reason I wanted to talk about this specifically is because you have a lot of people, even in the smart money circle, that are looking to pick off the top or the bottom of a range, of a trend, of a market structure, and then wondering why their order block didn't hold or why the breaker block didn't hold. And oftentimes it's because when we try to pick tops and bottoms, we are playing into exactly what the banks want to bring retail minds into believing, right? Since the price, and I talk about this with a lot of my clients in one-on-one sessions, since the price moves in such a way that quite literally creates an emotional approach in our minds to it, right? When we see movement like this, we expect that continuation upwards, even if we're trading smart money. When we see this up trend line form, we still continue to expect that to happen, despite the fact that we understand below these areas, there's a ton of liquidity, right? That could be traded to very soon. So what people will end up doing when they're looking at smart money concepts, they'll end up opening up a chart and then spotting the highs and the lows and looking at the order blocks within them, without recognizing that within price, we have a ton of order blocks that grab liquidity that actually get held very well, that come and trade into more liquidity zones, trading into imbalances and filling in other important mitigations before then dropping right through, right? So this might be an example of someone that traded this order block and ended up, for instance, taking a negative position, even though it was smart money driven, okay? The reason I talk about this is because, as you can see, this trade right here that I ended up sending out and the one I ended up taking wasn't really at the top or the bottom of anything. It was kind of smack down in the middle, right? Instead of looking for this grab right here and this being my entry, I waited. Sometimes that extra wait is what will allow you to get into trades or start to get trades that end up actually winning a much higher percentage of the time, okay? So what happens is when we try to pick tops and bottoms, these tops and bottoms are the exact same places that retail or people that, you know, are not really well versed in smart money concepts are bound to look at as well. Because what do they expect of these areas? For potential price reversals. So when you're looking at that area as a potential order block in the future, it might not get held the way you want it to, right? Like this order block right here doesn't get fully held and kind of trades through. This order block that forms here, guess what? Doesn't hold until this order block forms here, holds, and then you'd be waiting for this potentially. So you might have gotten a nice trade here, but ultimately this might have been your one good trade, and then you have this move down, this continuation up, and you might be looking for buys right here, maybe get in right here, or FOMO yourself in as a smart money trader and get taken out, right? Why does this happen? Because again, you're picking tops and bottoms just like retail does. It's just that sometimes with this extra confluence and knowledge of order blocks, you might not be getting you might not be too screwed doing that, right? So again, if we look at any point in the past when we've had order blocks like that form, right? We maybe had this order block right here form that only got traded to but not maybe mitigated here, and maybe you then took it here and notice how it just broke through, right? Maybe this order block formed and you traded it here and you got this consolidation, so very little profit taking if you were aiming for, of course, inefficiencies below, right before it got blown through again. Why does this happen? Because you're trying to pick a top and a bottom just like retail does, even though you're using smart money concepts and there are chances that you're going to pick it and you're going to pick it well. What's the point if you can wait for something, for price to basically tell you it's going to do something, for the smart money to make their movement in the market, then to start getting in onto the inefficiency, right? So smart money made their grabs of liquidity, finally began moving lower, breaking important structure, moving up to grab that liquidity on lower timeframes, because remember, price is fractal before moving lower, creating that order block with inefficiency, the trade into inefficiency on lower timeframes, and and then we look to enter, of course, off the order blocks in here, and we get a very simple 1 to 3 that played out quite perfectly, right? And then we also had the same thing occur on Australian dollar, US dollar last week. If we just move out to the hourly time frame, right, some of these trades may look absolutely insane, might look crazy. Like this trade is nowhere near the top or the bottom of anything we can see from a high time frame, right? This trade right here is actually within this consolidation, which actually played out perfectly to the T as we sent it out. So if we just go and look at that very quickly, I think it was on a 1 minute chart, but we can take a look at it very quickly. This was sent out, looking to take prices right at these equal lows, and we had a nice, perfect 1 to 4 play out on this. Maybe you had the stop loss right above the high, so yeah, there you go, about 1 to 4. What's the point of this video? The point of this video is to explain to you that the concepts that you are given and the ones you have to use for your arsenal can be applied to anywhere in price. Sometimes waiting for price to create an order block off an order block, or to give you that confluence and show you that price wants to move in a certain direction, is going to be the entry that actually ends up giving you a higher RR than the original entry itself. Okay, so what I want you to do for a second is consider the idea of cliff jumping. If you go to this new cliff jumping place with your friends or whatnot, and you're all looking down on it, like wondering, okay, you want to jump and it's going to look amazing, right? It looks like a fun time. You guys all want to jump in. But you also don't know how shallow it is. None of you have been there. So you know that if you jump, there's a chance that you can actually get very hurt. There's a chance that you break your bones. So my question is, would you jump in not knowing how shallow the certain areas of that cliff jumping area are and potentially risk death for the ability to have a little bit of fun? Or would you wait for someone else to jump, potentially die, and then go knowing where you can go, or go down there and check out how shallow it is, right? It's the same concept here. Why would you wait for that one order block or wait for that top to form and try to instantly get in, right? Try to instantly get in looking for those lower prices without waiting for the confluence of an order block that gives you an order block that gives you an order block, and then enter on the confluence. The same way as, why don't you let your friend go down there and check the shallowness of the water before you choose to jump in, right? You can have fun and you can start jumping, and you can have just as much as fun as the person that first jumps in risks his life potentially to jump as you can waiting for someone to jump and then going and playing with everyone else. That's what you're doing here. We are institutional and smart money traders. So what we're doing is we're waiting for smart money to get involved, leave their footprints in the market, show us that they have a prerogative to go in a certain direction, and then enter alongside them. That's why you'll see a lot of the trades I send out oftentimes, or the trades I end up taking, are ultimately within the middle of a price run or a range. Of course, on a lower time frame, it might be at the top or the low of a range. But even here, if you notice, I didn't get in at the high of this range. I got in when this range already was established, right? By that same token, if we look at any of these Australian dollar, US dollar trades we took, we got into these trades when they were already established, not at the top, not at the bottom, because that's not what we're looking for. We didn't get out at the bottom. We didn't get out at the bottom here, right? Maybe you held this and your risk management was perfect, so you ended up holding all the way down into here, but we didn't get in or out at the bottom. But guess what? We were still able to lock in 1 to 4.6, and of course, if you're risking 1%, that's 4.6% within about 4 hours, which is amazing and something that a lot of people can't do. Okay, so Again, we also had a few things we were looking at here. We had some pyramiding entries, and notice where these entries were. So the main entry that I actually sent out was this one right here. Notice where it's located in comparison to the rest of price. It's not the top and it's not the bottom at all. If anything, again, it's in the 50% of this entire range. And what you'll notice is, despite all these potential entries, even this order block entry that would have been perfect, the main entry I took was here. And notice how that entry on its own became a 1 to 7. The reason I point your attention to this is, imagine we took the sell right here at this order block, right, with your stop loss just above the high, as it should be, and your take profit at this exact same area. That trade on its own is a 1 to 1.46. Now, just waiting for price to actually play out more than half of this profit, and to show us that prerogative that it wanted to go lower to that area that we were looking at, right, from which point we can maybe anticipate higher prices, which we're not looking at right now, but let's say we did. Instead of catching this 1 to 1.4, our trade, we waited. And when we were given that inefficiency with the liquidity grabs on a lower time frame, our entry went from a 1 to 1.46 to an entry that was way lower at more than half of what the previous one moved, and gave us and delivered us an easy 1 to 7.69 RR. Which, again, if you were risking 1% or even 0.5%, netted you more percentage gain on your account than this trade would have. Right? So just imagine that if you risked 1% on this trade and 0.5% on this trade, you would have made more on this one. If you risked 0.25% on this trade, you would have made as much on this trade as you would have on this one. Okay? So the point of this is, consider it in the standpoint of cliff jumping. Why not wait to know it's safe and then have fun? Why not wait for the setup to present itself and then have fun, then bask in the glory? Okay? Sometimes you're going to miss out, and sometimes you're going to see price move without you. Other times you're going to get in perfectly. And sometimes you're going to get stopped, but at least you understand why you're getting stopped oftentimes, why you're getting in, and you're starting to use this arsenal of confluences and concepts that you have to get into price at a very, very good price, right? Based on where it is that you're getting in on. So of course, that's why I like to scalp so much. And of course, this applies to anything. If you're looking at a monthly or weekly chart and taking trades off an hourly, you can do that just as easily, right? When we zoom out and look at this Euro USD trade, notice where it is. It doesn't look at all like this is something that anybody would have taken. But on a lower time frame, seeing what price was looking to deliver to us and where price was most likely moving, we were able to frame a very nice 1 to 3. Relatively risk-free in understanding why we were forming it, okay? So this video is going to basically function as a small way to tell you that do not get emotional about your trading. There are going to be moves that you miss out on. There's going to be amazing moves that you miss out on. There's going to be huge moves that you miss. But the beautiful thing about understanding smart money is that you can then get into that move later. You can have basically any amount of moves to present themselves within the next hour, minute, day, whatever it might be, right? And that will also start to kind of play on the idea of being able to get in at any time on any currency, right? So once you get accustomed to doing it on one currency and seeing that there's going to be constant setups that present themselves over and over again, you won't have to worry about missing anything, because you understand that this thing will continue to work over and over again. And if you wait, that's where all the money lies. Sometimes it's hard to, but it's rewarding, and that's why you want to do it. Okay, so thank you for watching, guys. I hope this made a lot of sense, and I hope that you start to employ this in your trading, recognizing that the top or the bottom of a trade does not have to be the area where you get in. And sometimes even giving it a little bit of wait time can get you a better return than it would to just enter on that original area. Okay, hope this made a lot of sense. This is mentfx. Thank you so much for watching. Enjoy, guys.